Hello and welcome to the Financial Future Guide. I'm your guy, I'm your guide. My name's Alex and today we'll be analyzing SmartCentres, ticker symbol SRU.UN on the Toronto Stock Exchange. This is my pick for the next month and many months to come, as I truly believe in this company, and I will now take you through the reasons why. So here we're looking at the Yahoo Finance quote for SmartCentres Real Estate Investment Trust, ticker symbol SRU-UN.TO. Today we closed at $20.31 Canadian, down 23 cents or 1.12% on the day. SmartCentres has a market cap of $3.448 billion, trailing 12-month PE ratio of 9.78, a trailing 12-month earnings per share of $2.08, and a juicy 8.97% dividend, which is $1.85 Canadian per share. We're now looking at the stability and growth of payments, and by payments we mean dividends, we mean cha-ching, money in my pocket, so I like to see it. Currently they have the high dividend yield as we discussed previously, paying out $1.85 a share. We can see that back in 2014 this was $1.54 so $1.55. So they have been growing that over the last 6 years. Taking a quick look over here at the 1-year chart, we can see from the February highs we're down about 36.5%, and the 5-year trading range has sat anywhere between the high 30s and the low 30s. Boom, here's the investor presentation from Q1 2020. This came out about a week ago. So I thought I'd go through that real quick and we could have a look at this. A quick little history recap. Let's throw it back to 1989, and Mitchell Goldhar, the good man he is, said, "I'm bringing Walmart to Canada. Let's do this, baby." And next thing you know, 1999, Walmart gives him a call. He goes, "Hey, mate, yeah, I'm totally down for a joint venture. Let's do it." And they skate on over to Canada. Now we're looking at 2016. This is very important. SmartCentres looks at diversifying their portfolio, which is great to see. And we'll get into that more later. In 2018 and 2019, SmartCentres said, "Hey, you want a helping hand? We like you, you like us, let's do this." And they partnered with some very key companies that will definitely deliver growth in the future. SmartCentres has 166 properties across Canada with a 98% occupancy rate. Now that is extremely high. It's great. It's not full, but it's about as good as it gets. 25% of their revenue comes from Walmart, and I don't know about you, but me personally, Walmart's not going anywhere. 60% of the tenants were deemed essential services and remained open, so despite having to limit numbers in the store and mandate that, they were able to remain open. Now looking at who they have for tenants, they got Walmart, Loblaws, Shoppers Drug Mart, Canadian Tire, Lowe's, Dollarama, McDouble-D's, and we're all about that. So many of these are not only open, but strong businesses that will remain tenants or become new tenants in the long run. Looking at the high quality tenants that SmartCentres have, these tenants represent 37% of the total rental income, and none of them are going away anytime soon. Walmart, bang, they love their man Mitch and they're sticking with him. Canadian Tire, another strong partner. Winners, Marshalls, HomeSense, Loblaws, these are all places that I don't see going away in the near future, or honestly even the long term. Now looking over here, SmartCentres say they're built for heavy weather. That means rain, shine, it's all fine. Hit them with a lightning bolt. They do not worry. They're here to stay. That portfolio is valued at approximately $10.4 billion. Funds from operations are up 8.7% at $96 million, and the adjusted cash flow from operations is up 13% to $19 million. Now we're heading over to the financial statements. We'll start with the income statement. As we can see, total revenue has increased over the last 4 years. Gross profit has done the same. And operating income has seen steady increases in this 4-year period. Now we pay off interest. The tax man comes knocking. He says, "Put the money in the bag, fella." We do so, and we're left with the net income. This is sitting at $301 million, which is fairly consistent with what we've seen over the last 4 years. So now we're heading over to the balance sheet. As we can see, total cash sits at about 55 million, total current assets at 179 million, and total non-current assets at 9.749 billion. This has been steadily increasing over the last 4 years. This is due to equity and other investments, where we've seen 122 to 146 million in the previous 3 years, and in 2019 they went hard to the paint with a whopping $345 million in investments. This is great to see for a REIT because it means they're adding properties to their portfolio and growing this, which is exactly what we want to see for the long term. We can see that total current liabilities is down quite a bit from previous years, and total non-current liabilities has been increasing steadily. This is due to the long-term debt. If we take the total liabilities and we divide it by the total assets, so that's 4.56 billion divided 9.928 billion, we can see that we get a ratio of 0.459, so let's call it 0.46, and that's very close to the 0.5 debt to asset ratio that I tend to look for. Alrighty, let's whip on over to the cash flow. Let's take a look at this real quick. Net income, we discussed previously. Now we'll come down to net cash from operations. We're sitting at 368 million for the trailing 12 months. This is slightly higher than we've seen in the past 4 years, but we're sitting around that range. Let's get on down to net cash used for investing activities. We can see that in 2019 we were at 448 million, which is quite substantial compared to previous years, and that is due to acquisitions. Now, we like those acquisitions because they say, hey, that's a nice property, now give me that. And they add it to the SmartCentres portfolio. That's what I like to see, long-term sustainable growth by adding more high-value properties to their portfolio. Debt repayment, we expect to see it. A REIT's always going to have debt. You can't fund these huge projects and execute them fantastically without the money to do so. We can see in 2019, 220 million shares have been issued, and that obviously dilutes shareholders. It affects earnings per share. We can get into that shortly. Dividends paid. I expect SmartCentres to continue to pay out their dividend. I don't see any issue in terms of their dividend payout ratio. With REITs, we do expect this to be quite high, as there is great tax implications for them doing so. Free cash flow sits at 367 million. This is slightly higher than previous years, but fairly steady. SmartCentres has 256 individual development projects across 94 properties. Now, if we look to the right over here, self-storage, 48, I like it. You got extra stuff, they have somewhere to put it, bang, done. And that's a joint venture. We look at the apartment living and the condo townhouses, which is a big part of this growth. And I will get more into why I think that's so important for SmartCentres and the amount of value that will deliver very shortly. Now, senior living, that's definitely one I'm pretty excited for. In the next 15 to 20 years, this will be very important given Canada's aging population and an average age of about 41. Now, that's going to be 2,000 units across 7 properties. These are for senior apartments and retirement residencies, no long-term care. I like this because SmartCentres is saying, hey, we know how to build places to live. We know how to build property. We're not here to look after grandma. We're here to give her a home and leave it at that. Value creation, what a key component that they're focused on. I love it. I love it a lot. So this is looking at properties and developing them further more than they currently are. Looking at this here is a perfect example of SmartCentres' intensification process. At this project here, they have 48 acres with 546,000 square feet of retail. There's a Walmart, there's a Lowe's right in here. Boom, bam, you love it. This is 5 minutes away from Pickering GO Station, which obviously is a big transit line. Bang, look at that. Look at these properties. There's an opportunity to consolidate and build up to 8 million square feet. The intensification creates density. They're already undergoing plans to include high-rise condos, townhouses, senior residence, apartments, and a hotel. The reason I love this so much is building up. They are using the same land and adding the amount of value to it. As a tenant such as Walmart, who owns property currently on this land, they are going to love SmartCentres for bringing many more people to the area and essentially growing their customer base. Not only does that assist this particular Walmart or this particular Lowe's, any of the tenants, this will also encourage these tenants to continue to grow with SmartCentres and choose SmartCentres for their new locations as they continue to open across Canada. Oakville North, this is very close to where I live, and boom, intensification, I love it. Now, the town recently initiated an official plan review for the Uptown core. This will be the perfect new hotspot for Uptown Oakville. As we can see, there's a lot of other development up the top here, so I expect them to continue to grow this area. A quick look at how SmartCentres was managing COVID. Obviously, that is a big issue at this time, and they need to be acting accordingly. So in the middle of March for Canada, all non-essential businesses were closed. The majority of SmartCentres tenants were in fact deemed essential and remained open. March 19th, SmartCentre confirmed its intention to stand by small independent retailers. They said, hey little guy, don't worry, I got your back. And on March 27th, which is my birthday, they said, happy birthday to you, mate. Don't worry about it. 2 months of rent deferral. This is great for these small companies. They don't want to lose their tenants. Their tenants respect them. They respect their tenants. They said, hey, don't worry about it. Pay us back later. Now, taking a look at the board members and the ownership here, we have a whopping $351.3 million, which accounts to 9.95% stake in SmartCentres from our man Mitchell Goldhar. He knows what he's doing. He has skin in the game. I love to see it. He is the president of the council, taking an advisory position for the company. So if we look at the recent insider trading, we can see back in late December, my man Mitch was dropping almost $1 million at prices of $31.15, close to $1 million at $30.86. He's here again at $28.78, dropping another million, another $1.5 million. And then he just went, oh my Lord, it's dropping like flies. $2 million in at $18.20. He's saying, give me that, I'll take it. If you don't want it, I will. I'm happy. I am the Mitch man. So in conclusion, I just wanted to review some of the points that I discussed today and why I believe SmartCentres is a great buy right now. Firstly, they're still down 36.5%. The real estate sector has not bounced back as much as many other industries and sectors. This is a big factor as it's not easy to find value in the current market given the way that it's bounced back, and there still is a lot of uncertainty. But as we can see, the majority of SmartCentres tenants are still able to stay open, which means that even if we were to go through a second wave of the virus, they would be able to battle the storm. Number 2. I think that the company is setting themselves up well for growth and long-term sustainability with the partnerships they've made, with the acquisitions they've made, and their overall goal for growth. Point 3 is the insider purchasing. I think that the fact that Mitchell is putting down so much money in his own company, he believes that this is where his money should be to bring back the best returns, and he's willing to put it in. It makes me confident that I am investing in the right company with the right management team that will have that long-term growth that I'm looking for. Number 4 is the dividend. I am very interested in real estate investing. It's a great way for young people or people who do not have a lot of capital to invest to get into the real estate industry. Finally, I would like to say that I am not a financial advisor. These are my opinions and my analysis of the company. Please do your own research before purchasing. And that will conclude today's Financial Future Guide. Feel free to subscribe and like this video. Please let me know in the comments below your thoughts or any suggestions you may have. All right, see ya.